Ever wondered how a simple $100 monthly investment can turn into $225,000? I wish I knew this sooner. As a Gen Z money expert, I've seen how intimidating it can be to start investing, especially for our generation. You're listening to Priceless Tay, and we're here to combat financial literacy, ensuring young people financially thrive, not just survive. I'm pumped about today's episode, which dives into the topic that can feel both exciting and overwhelming and scary and nerve-wracking, and that is investing in stocks. As a Gen Z money expert, I've seen how intimidating it can be to start investing, especially for our generation. I mean, most of us weren't actually ever taught this in school or didn't have conversations with family or friends about it. But don't worry, because in this episode, we'll walk through everything you need to know to get started on your stock investing journey and build long-term wealth. We'll also get into my personal investment journey and what I wish I knew from the start. You can find us on YouTube, Instagram, TikTok, and LinkedIn at Priceless Tay. And make sure to check out the show notes for links to everything we talk about in this episode at pricelesstay.com/6. Enjoy the show. Imagine waking up one morning and checking your investment portfolio to find that it has substantially grown overnight. That dream of building long-term wealth through the stock market is no longer a fantasy, but a reality within your grasp. You got this, bro. I mean, it is so close. You're listening to this episode. But I want to say, as a beginner investor, the idea of investing in stocks can seem daunting and overwhelming. Where do you even start? That's one of the most common questions I get. Well, I want you to fear not, because Tay don't play. Because in today's episode, we are spilling all of the wealth secrets. One of the most crucial steps for beginners embarking on their stock investing journey is to set clear investment goals. And I want you to know that throughout the episode, I might say just investing, but what I mean is stocks, investing in stocks. That is what today's episode is about. You can invest in other assets, things that make you money in the long term, but we are talking about stocks. Going back here. So without this well-defined objective, it's easy to make very impulsive decisions or chase unrealistic returns, which can lead to disappointment and financial setbacks. First and foremost, you need to define your financial objectives. Are you investing for long-term growth with the aim of building a nest egg for retirement? Or maybe you're seeking to generate a steady stream of income to supplement your current earnings. Maybe you're simply looking to grow your net worth, what your monetary value is, over time. Or maybe you just want to not have to be tied down to a 9-to-5 anymore and want to start growing your wealth. Let me tell you, all the above is possible with the right investment strategy, even at a young age. Clearly identifying your goals will help you make informed decisions about where to allocate your investments and how to structure your portfolio. So I want to get into a little story time. So my first investment account was actually a custodial account under my parents with E-Trade. I don't really see a lot of E-Trade in social media, but it was with E-Trade. This was before commission-free trading, and I'll get to what that means at some point in the episode. My mom, who graduated with a bachelor's degree in finance from Baruch College in the city, advised me to check out high-yield dividend stocks. I had no idea what this meant, but after some quick Google research, my first investment was in a Vanguard fund with high yield dividends, needing a $3,000 huge minimum investment at the time. And that was such an absurd amount for me. This was also too when fractional investing really wasn't a thing. But that first investment taught me a lot about the importance of starting early and investing often. Next, let's pivot to the core of today's topic to follow an investment strategy that actually pays off. Stay tuned after the break. Summer is upon us, and it's about to be the best one yet. Why? Because this summer, you're feeling yourself and are ready to be a freak in the sheets. A freak in the sheets, Tay? Are you serious? I know you're absolutely dying to be a freak in the sheets this summer. And that's why I present to you Priceless Tay's budget template. Get down and dirty in the sheets. Go from broke to bougie. And take control of your money instead of it controlling you this summer. Go to pricelesstay.com/budget template to learn more. Check it out. In my early investing days, shout out those who know, I had no clear goals. I was just buying stocks based on trends. It wasn't until I set specific goals for retirement saving and passive income that I saw significant progress in my portfolio. Having those goals kept me focused and disciplined, which brings me to an essential point. Determine your risk tolerance. Investing in stocks inherently carries a certain level of risk, and your ability to stomach market fluctuations, meaning the market does good one day, your portfolio does good, the market does bad another day, you start losing money. That plays a significant role in shaping your investment strategy. If you have a low risk tolerance, you may want to consider a more conservative approach with a greater emphasis on bonds and other fixed income investments. On the contrary, if you have a higher risk tolerance and a longer investment horizon, meaning that you don't plan on retiring within the next 20, 30, 40, maybe even 50 years, depending on how old you are listening to this episode, you may be more comfortable with a more aggressive portfolio tilted towards stocks. Defining your time horizon is crucial for setting appropriate investment goals. A longer time horizon allows you to take on more risk and focus on growth, while a shorter time horizon may require a more conservative approach, prioritizing capital preservation. And that might be a big word for some. Basically, what it is you have all this money in your little nest. You want to keep it and you don't want it to go, and you want it to grow little by little, and you don't want to see your nest be empty. That's basically what capital preservation means. Quantifying your goals with specific target amounts can help you track progress and make adjustments as needed. For example, if your goal is retirement savings, determine how much you'll need to accumulate based on your desired retirement lifestyle. Of course, we have a tool for you to figure out that number. Go to pricelesstay.com/retirement to find out exactly how much money you need to stop working. By setting clear investment goals, understanding your risk tolerance, and determining your investment budget, you'll be laying a solid foundation for your stock investing journey. With these key elements in place, you'll be better equipped to make informed decisions and stay on track towards achieving those priceless financial goals. Wondering what your risk tolerance is too? Yeah, we got Tay on Play. Take our investor profile quiz to figure out what type of investor you are. Visit pricelesstay.com/retirement to also take that quiz. Let's shift gears now. So you're like, Tay, I need to set goals and choose my risk tolerance, but what should I actually invest in? Stay tuned for this after the break. So, you're diving into the exciting world of investing, ready to build your wealth and secure your financial future. But before you take the plunge, let's take a little step back and ask an important question. Do you have an emergency fund set up? Having a solid financial foundation is crucial before you start investing. You can think of this like building a house. you wouldn't start without a strong foundation. Like you need that concrete poured before you start putting in the time to work on the rest. So if you're not sure whether you have a strong enough financial foundation to start investing, don't worry. Tay, don't play. We got you covered over here. I dedicated an entire episode to helping you determine if you're truly ready to begin your investing journey. To learn more about how to assess and strengthen your financial foundation before you start investing, listen to that episode by visiting pricelesstay.com/3. pricelesstay.com/3. Trust me, it's a game changer for anyone serious about getting their finances in order before entering the world of investing. By the way, this episode is brought to you by our friends. These friends offer one of the highest returns on your money for a high yield savings account. I mean, should I say even more? I want you to head over to pricelesstay.com/HYSA to get a special offer on our friends' services. Happy investing! As a reminder, you're listening to Priceless Tay, and you already know we're here to combat financial illiteracy, ensuring what? Young people, you guessed it, financially thrive and not just survive. Once you've established your investment goals, the next step is to choose the right investment vehicle to help you achieve them. With so many options available, it can be overwhelming for beginners to navigate these various account types and investment platforms. However, making an informed decision at this stage will significantly impact your long-term success as an investor. For instance, let's rewind to when I first dipped my toes into investing. I initially opened a brokerage account under my parents. It worked for me at the time, but looking back, I realized there are other options that may have been more beneficial. One popular choice for many investors is a traditional brokerage account. These accounts offer a wide range of investment options, including individual stocks, bonds, mutual funds, and exchange-traded funds, or otherwise called ETFs. Brokerage accounts are typically taxable, meaning you'll owe taxes on any wins or losses. If you lose, you can write some off. If you gain, you'll probably have to add that into capital gains or any sort of interest or dividend earned. But they also offer flexibility in terms of when you can buy and sell investments. This scares some people off, but truly investing is one of the only ways for us to beat current rates of inflation. So consider a traditional or Roth IRA for tax advantages and long-term growth potential if investing for retirement. These accounts allow you to contribute a certain amount each year. This rate changes variably, so make sure to go to our show notes for that and provide tax-deferred or tax-free growth depending on the type of IRA. Another option to consider is a tax-advantaged retirement account, such as the Roth IRA, and this account really does benefit you in that it can help your investments grow over time without the crazy taxes that an individual brokerage account might suffer. So with a traditional IRA, your contributions are tax deductible and your investments grow tax deferred until you begin making withdrawals in retirement. On the other hand, a Roth IRA, and this is the typical option since hypothetically you're in a smaller tax bracket in your younger years than if you're in your most maximum potential earning years, like in your 40s and 50s, which is why a lot of experts recommend going for the Roth IRA now because it's funded with after-tax dollars. So you're paying today those taxes within your tax rate right now. So if you're a really high earner right now, that might not be the way to go for you. If you're in a lower tax bracket right now, Roth IRA probably most suitable for you. Your withdrawals in retirement are generally tax-free here. Regardless of which investment vehicle you choose, it's essential to consider factors such as fees, investment minimums, and the range of investment options available. So, with these retirement accounts, it's important to note that if you try to take out money prior to retirement, the standard retirement age, you may incur a fee. So that's important to note too, and that's also denoted into the show notes as well. pricelesstay.com/6. Additionally, be sure to research the reputation and track record of any financial institution or platform you're considering. By carefully selecting the right investment vehicle, you'll be setting yourself up for success by aligning your investments with your specific goals and preferences. Now that you've set clear investment goals and chosen the right investment vehicle for you, it's time to take the next step and open a brokerage account. This account will serve as your gateway to the whole world of investing, allow you to buy, sell, and manage your investments. When I first opened my brokerage account, I remember feeling excited, but anxiety as well too. It felt like I was taking a big step into the world of investing. Choosing a reputable brokerage firm was key, as well as commission-free, or at the time, low commission trading. Choose a brokerage firm with a user-friendly platform. It's online. They have a mobile app for easy account management. Look for firms that provide robust research, analysis tools, as well as educational resources to help you make informed decisions, especially as a beginner. And those that have free resources are definitely a plus too. And making sure that you have the option to either do or both commission-free trading. Back in the day, you used to have to pay for every single trade that or investment that you would make. You would have to give the guys a little bit just to do that transaction. That's pretty much no longer a thing. So make sure that you are looking at brokerages that are commission-free. And then secondly, taking a look at fractional investing as well too. Some these days do not offer fractional investing, but if you're definitely a beginner, this is where I would go. I would go to a place that also offers fractional investing so that I can invest $1, $5, $10 into different stocks and start feeling what it's like to begin the investing journey. Once you've identified a brokerage firm that meets your criteria, the account opening process is typically straightforward. You'll need to provide personal information such as your name, address, SSN, that social security number, as well as information about your investment objectives, risk tolerance, and financial situation. Make sure to compare those account fees. I can't talk about this enough because over time, it's insane how much those fees could eat at your portfolio. And I'm talking literally hundreds of thousands if we're talking about 30 to 40 years. Trading commissions and investment minimums as well too across different brokerages. You got to find that most cost-effective option that fits your needs. Consider those brokers that offer the commission-free trading on certain investments like ETFs, exchange-traded funds, to help minimize costs as you build a portfolio. We have more friends at some of our favorite brokerages, and right now they are offering a special deal at the time this episode launches. So I want you to head over to pricelesstay.com/brokerage to check those friends out. That's pricelesstay.com/brokerage to check it out. After completing the application process, you'll need to fund your account with the desired amount of money. It's important to note that some brokerage firms may require a minimum initial deposit, so be sure to review their requirements before opening an account. Once your account is funded, you'll have access to a wide range of investment options and tools to help you manage your portfolio. Many brokers offer research and analysis tools as well as educational resources to help you be the most informed investor that you can be. And remember, opening a brokerage account is just the first step in your stock investing journey. It's essential to continue educating yourself, monitoring your investments, and making adjustments as needed to ensure that your portfolio remains aligned with your long-term goals. Now that you've got your brokerage account set up, it's time to talk about actually selecting your investments. This can be one of the most exciting yet challenging parts of investing. As a beginner, it's important to start with a solid foundation. Remember a house analogy that we always talk about, and focus on diversified, low-cost funds like ETFs and mutual funds. ETFs, or exchange traded funds, and mutual funds, I know I tossed it around in this episode a few times. They're excellent choices for beginners because they offer diversification, meaning they spread your investment across a wide range of assets. The common analogy here is an Easter basket. There's so many different forms of candy when you get an Easter basket. If you celebrated Easter growing up, ETF is a similar thing. It's like basically you buy this one basket and it has a whole bunch of stocks in there. This helps reduce risk compared to investing in just an individual stock or individual company. Look for funds with low expense ratios, as high fees can eat into your returns over time. And like I said, it could be hundreds to thousands of dollars. Dollar cost averaging, too, is another powerful strategy to consider. And if you're listening to this episode or watching this episode right now thinking like, I don't have that $3,000 Taylor to start, guess what? You don't, because dollar cost averaging over a period of 30 years from 1993, I believe, to 2020, whatever, the 2020 something, that return, if you had invested $1,000 versus invested like $10 every month, you would have returned more by investing every month rather than investing in one lump sum. And how dollar cost averaging works is that it involves investing this fixed amount of money at regular intervals, regardless of how the market's doing, if it's in a bear market or it's in a bull market. By consistently investing over time, you can mitigate the impact of market volatility and take advantage of lower prices during market downturns. Like I was saying, an investment of $100 per month, not $10, sorry, over a period of 30 years with an average annual return of around 10% would have grown to approximately $225,086.67 due to the power of compounding and dollar cost averaging. Consistency here is the key, my friends. Another thing to keep in mind is to avoid the temptation of trying to time the market. I wish I knew this sooner. Many investors believe they can buy low, sell high, but even most experienced investors find it challenging to predict market movements consistently. Instead, focus on long-term investment strategies and stick to your plan. The truth is, studies have shown that investors who regularly monitor their accounts and make frequent trades often underperform compared to those who take a more hands-off approach. And now, again, you might be a more technical trader and active trading might be suitable for you and you are good at it. Other people, that just might not be the deal. Emotional trading decisions can lead to buying high and selling low, which overall, as you know, can hurt your returns as you left with less money than you had to begin with. Once you've built, though, your investment portfolio, it doesn't stop there. It's important to monitor and rebalance it regularly to stay aligned with your goals and your risk tolerance. Monitoring your portfolio doesn't mean checking it every day. A lot of people think that it does. It does not. In fact, it's often counterproductive to do that. Instead, aim to review your investments on a quarterly, monthly, or semi-annual basis. I used to check my investment account daily, and it did take a lot of my time. I'd get stressed over every little fluctuation. Eventually, I learned that less frequent monitoring led to better decision making and less stress. Rebalancing involves adjusting your portfolio to maintain your desired asset allocation. For example, if your target allocation is 70% stocks and 30% bonds, but due to market fluctuations, your portfolio shifts to 80% stocks and 20% bonds, you'll need to sell some stocks and buy bonds to get back your original allocation. Remember, rebalancing your portfolio helps manage risk by ensuring your asset allocation remains in line with your investment goals and risk tolerance. It prevents your portfolio from becoming heavily weighted in one asset class. Studies have also shown, too, that investors who look at their accounts every few months outperform than those who check daily. When I came across this, I was like, wow, this is because less frequent monitoring reduces emotional trading decisions and allows for a more long-term perspective. Investing is a journey, and there's always more to learn. Continuously educating yourself on market trends, you have to, because they change. Investment strategies and personal finance can help you make informed decisions and stay ahead of the curve. There are plenty of resources available, from books to online courses to podcast episodes to financial news websites. When I first started investing, I spent a lot of time reading books and articles about the stock market. I mean, a lot. It consumed my entire day. One of my favorite books was The Intelligent Investor by Benjamin Graham, and it taught me the importance of value investing and staying disciplined in my approach. Reading financial news, watching the news in the morning time, CNBC, and subscribing to investment newsletters can help you stay updated on market developments and make informed decisions. Websites like Investopedia, Bloomberg, CNBC, I spent a lot of time on there, are excellent sources for financial news and analysis. By continuing educating yourself, you'll be better prepared and equipped to navigate the complexities of the stock market and make informed investment decisions. Remember, though, knowledge is power, and it's power when applied. And the more you learn, the more confident and successful you'll become as an investor. One of the biggest challenges for investors, especially beginners, is avoiding emotional decisions. The stock market can be volatile, and it's easy to get caught up in the excitement of a bull market or the fear of a bear market. However, making investment decisions based on emotions rather than logic and strategy can lead to poor outcomes. I remember when I first started investing, I made the mistake of selling my stocks during a market downturn out of fear. I panicked and locked in my losses. It wasn't until later that I learned the importance of staying calm and sticking to my investment plan, even during this roller coaster of market volatility. To avoid those emotional decisions, I have that clear investment plan. I like sticky notes and literally stick to it. Set predefined rules for buying and selling investments and avoid making impulsive decisions based on short-term market movements. This includes setting target prices for buying and selling investments and sticking to those targets regardless of market noise. Also, consider implementing automated investment strategies like dollar cost averaging, which we just talked about, and automatic rebalancing, maybe using a robo-advisor to remove the emotional element from your investment decisions. All right, Priceless Pack, you made it to the end of this episode. I want you to reflect on the key steps we covered here. So we began by emphasizing the importance of setting clear investment goals, align with your risk tolerance and financial situation. Reflecting on my own journey, starting with a custodial account and making my first investment in a Vanguard fund, I can attest to the importance of setting clear goals and staying disciplined. It's a journey that requires patience and continuous learning. Remember, investing in stocks is a journey, and there's always more to learn, especially as the market moves. By following the steps outlined in this guide, you can establish a solid foundation and increase your chances of success. Stay disciplined, stay informed, stay focused on your long-term goals, and stay priceless. The stock market is awaiting for you, babe, and with the right mindset and strategies, you can turn your financial dreams into that reality.